Hello class. One of you had a question about how to compute the under or overstated net income if certain adjusting entries are not made. This relates to quiz number 3, and I think it was problems or questions 2 and 4 on that quiz. So I'm trying to create a quick video here just to lead you through part of this. So let me see if I can get started. So let me scroll down to Chapter 3 quiz. Let's start it. And to get to question 2, I'm just going to enter an item here, just enough to get to the next question. Yes. So in this question, they ask for a series of adjusting entries, and then they ask for, if those entries were not made, what would be the overall overstatement or understatement of net income. So for example, the first one, your numbers will be different. The questions are the same, the wording's the same, but the numbers are different. So if they say depreciation is $300, you know that you're going to debit depreciation expense, credit accumulated depreciation for $300. Okay. Now when you look at this, you should know that as you increase expenses, which you do with a debit, that has the effect of lowering net income. So this is what you have to do. Go through each of these entries, make the adjustment. Go to the second one here. Let's just do this one real quick. Prepaid rent expired, $900. So that means it's now rent expense, and we are going to reduce the asset account called prepaid rent. And this is 900. So on this one, we increased expenses again, which has the effect of lowering net income. Now, if these first two entries were not made, then net income would be overstated by $300 for the first entry and $900 for the second entry. And I apologize for my voice since the allergies are getting to me. So what you need to do is go through each of these entries, make them, and then at the very end you go back through the entries and find out how each one impacted net income, total all the impacts up, whether it's a positive or negative, and get the overall change. So I don't have time to go through every one of these, but let's just do one more. E here, unearned revenue. You're going to take off the unearned revenue, which is a liability. You earn that, and now that will be service revenue for $800. So this is an example of if you did not make this entry. Okay, on this entry, it increased revenue, which will increase net income. If this entry was not made, then income would be understated. So if you don't record an expense, net income is overstated. If you don't record a revenue, net income is understated. So that's what you do with each of these, and then again, as I said, go to the bottom after you add up all the items A through F and put down the total here. And you indicate whether it's over or understated and type in the dollar amount. Now, question 4 was similar, but it is more detailed. So let me move to question 4. Let me say yes here, even though I'm not complete. I'm just going to type a number in here so that I can move to the next question. And this is number 4. The first part is the same. We have various adjusting entries you have to make. 1 through, or this A through E. So on the first one, they want us to record the utility bill they received, and it's not going to get paid until January 5th. So this will be utility expense. Since we incurred this expense this year, we do owe the money, so the utilities payable. The dollar amount is $150. We'll type this in. So there's the first entry. utilities expense and utilities payable. We have an expense account and a liability account. Now to analyze this one, let me just get this out of the way. Come to the bottom and entry A, which accounts were affected? Well, an expense is an equity account. A liability is, of course, a liability account. If we don't record the entry, then the equity would be overstated because an expense is an equity account. It lowers net income, which then will lower retained earnings, which will lower equity. So if we don't make the entry for expense, equity is overstated. And if we don't record the liability account is understated. What kind of account in the income statement was affected? It was an expense account. And that expense account was understated if we don't make the entry. So you have to, on this one, not with the numbers, but just with the account categories and how it was affected, go through each of the entries above to come up with the answer. So I hope this helps. Review it a couple of times and let me know if you have any questions.